What's up, you guys? Welcome back to the channel. My name's Nick, and in today's video I'm sharing with you why I choose to invest in index funds over mutual funds. Be sure to stick around all the way to the end of the video, and I'm going to be sharing with you how you could win $50 from none other than me. So let's get started. This is a controversial topic in the investment community because I know plenty of people who prefer index funds over mutual funds and vice versa. But you guys just have to remember, before you hate on this video, if you're one of those people who enjoy mutual funds, just remember that at the end of the day, we're all making money. Some people will make more than others depending on what they invest in. At the end of the day, we have no way of knowing what's going to happen. All we have is past performances to base our current decisions on. Index funds have been around since the 1970s and was created by Jack Bogle, who is the founder of Vanguard. Index funds are extremely similar to what mutual funds are. It's just that index funds mirror whatever index that they are following. For example, the S&P 500 index fund is going to have exactly in it what is actually in the S&P 500. This means that the S&P 500 index fund is going to pretty much mirror exactly what the S&P 500 does. Since these funds are a lot easier to manage than mutual funds, the expense ratios associated with them are a lot cheaper. This means that index funds are a lot cheaper to own. For example, the expense ratios on an index fund can range anywhere from 0.015 to 0.04, meaning that on about a $100,000 balance, you could be paying anywhere from $15 to $40 per year on your balance. Another great perk that index funds have is that there is no minimum, meaning you could take just $1, put it into this index fund, and now you own whatever that $1 will buy you. Index funds are a lot more conservative of an investment because when you purchase an index fund, you are just going to get whatever the index does. With a mutual fund, the mutual fund is actually trying to outperform the index, meaning that they're going to be buying different sets of stock than what is actually in the index because they're trying to get higher gains. So they're willing to take more risks on buying stocks that they think are going to have a higher value than the ones that are just going off of that index. If that didn't make any sense to you, let's use cookies as an example. Let's say that the S&P 500 really is 500 different kinds of cookies, and I'm a manager for a mutual fund, and I think that chocolate chip cookies are going to have a lot higher of a gain this year than all the other 499 cookies in this fund. I am the manager. I'm going to actually buy a lot more chocolate chip cookies than I will all the other ones, and then if I am correct, my mutual fund will perform higher than the S&P 500 index fund. Unless I, of course, I eat all the cookies, which then I'll make no money. So why is it that I like index funds more than I do mutual funds if mutual funds have a chance at earning more than index funds do? Well, stick around because I'm going to be explaining that now. Mutual funds have been around considerably longer than index funds have. There are some funds that have even been open for up to 80 years. The goal of the mutual fund is to outperform whatever the index is doing. So if the S&P index is averaging 10% gains for that year, then that means that my job as the manager is to actually get more than that 10%, something like 11, 12, 13, even 20, who cares? So it sounds like we should all invest in mutual funds, right? Well, no, we shouldn't, because mutual fund managers don't like cookies. I'm just kidding. I'm not an investment professional that makes my decisions based off of whether somebody likes cookies or not. However, if they don't like cookies, I would very strongly advise that you don't trust their character. But there are seriously a lot of financial gurus that recommend investing in mutual funds. And if you invest in mutual funds, I have absolutely no hate, but here are a few reasons why I don't like them. Over the past 15 years, only 92% of mutual funds outperformed the index. There are roughly 9,600 mutual funds, meaning that somewhere around 750-ish actually outperform their index. Now, I'll be completely honest with you. I am not an investment professional, so please don't take my word as gospel or anything along those lines. I'm just telling you what I observe. But if you're going to tell me that I have a 92% chance that I will earn less than whatever the index is, I think that's a little too high. If I only have an 8% chance at earning higher than whatever the index is, I don't feel comfortable making that decision. I am just going to go with the index. If I were to get lucky and pick a winner, I would surely boast and probably talk a lot of smack to all my friends that have index funds for this exact reason, that mutual funds can earn higher than the index funds. However, if there's 100 people in the room, only 8 of them, by the odds of 92 to 8, are going to pick something higher than the index. And I don't want to place my odds on my investment in my retirement that I'm going to be one of the 8. Not to mention the expense ratios are considerably higher on mutual funds. So that means that mutual funds do have to perform just a little bit higher than index funds do just to be able to beat them. Since 1926, the S&P 500 has averaged anywhere from 10 to 11%. This means that me being 25 right now, over the next 34 years, if I could average that 10 to 11%, I'll end up with more than a couple $1,000,000 in my Roth IRA if my wife and I could both max our Roth IRA out very religiously every single year for the next 34 years. Now, obviously, this is only true if it continues to do 10 to 11%. If for some reason it does higher, we'll have more. If it does less, we'll have less. In conclusion, I think that both index funds and mutual funds are a perfectly fine investment. However, I'm going to lean a little bit more towards the index funds on this one because, hey, I'm happy with just getting the index. If I make an extra 1 or 2% buying a mutual fund, I'm sure I'll be happy, but I'm perfectly okay with getting that 10, 11%. That's not bad gains at all if it does that. So with that being said, now that we're at the end of the video, I'm going to show you how you can win $50 from me. All you have to do is subscribe to this channel. If you subscribe to this channel, once we hit 500 subscribers, we're going to be looking through our list of subscribers and randomly picking from a little number generator which one will be receiving the $50. We'll find a way to get a hold of you. We'll send you the code for the gift card. So be sure you guys subscribe. Now, in order for us to see that you actually are subscribed, make sure you go into your settings on your YouTube channel and hit the turn my subscriptions to public. Some of yours are hidden. We can't see who you are, so make sure you turn it to public to be eligible to receive this $50. So with that being said, you guys, I hope that you have enjoyed this video. As always, be sure to subscribe, like this video, share this video with your friends. If you have any comments or suggestions on new videos that we should do, be sure to leave them down in the comments. Check out the description link if you want to do Instacart, DoorDash, Grubhub, or you want a 30-day free trial to Amazon Prime. And as always, I hope you guys have a great day or night or whatever it is when you're watching. God bless you, and I'll see you guys in the next video. Peace.